Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. And we are back. Hi, everybody. Welcome to the latest Carson's Facts versus Feelings. Ryan and Sonu here. Sonu, this is episode 164, back to December. Sonu, wake up. Wake up. Are you asleep on me?
Not with all the technical difficulties we had for the last half hour. I'm definitely awake now.
That was just to keep you up. Yeah. So.
I know. See if I'm on the up and up. But no, yeah. I've been up since 3:30 in the morning. So after spending 10 days in the Middle East, by the way, I did get to swim right next to the Straits of Hormuz. How about that? Near the Persian Gulf. We went snorkeling. We saw some turtles, some sharks, some small sharks. I mean, you know. So yes, I can actually say I was swimming in the Gulf there. So.
And that was a big deal. Well, I mean, this is terrible. I remember hearing a lot about that. Why was that a big deal earlier this year? Was that some trade going on? Why did I hear about that whole
kerfuffle with Iran?
Yeah.
And
that's what it was.
That's what it was. That's what it was. And here I was snorkeling, gorgeous waters, I should say. And my kids are a little worried about snorkeling. Have you been snorkeling? Are you a snorkeling guy?
I mean, no, I don't do the one where you go like far into water needing a tank, you know.
Yeah. I don't have a diving license, but snorkeling's fun. Mm-hmm. The waves, we stopped at two locations. At the second location, the waves were a little on the rougher side. My kids got into the water. They're 9, just so that, for everyone listening. And they were like, oh, we need to get out. We're scared. So I was like, okay.
Yeah, that's how it goes. It's cold outside now. There's snow on a lot of different places. So again, welcome to December, everybody. And we're calling this one Back to December. We're hoping maybe we'll get some Taylor Swift algos when they see this title. So we're going to hit on a lot of stuff today.
You had to tell me that. I couldn't have told this is a Taylor Swift lyric.
When you spend as much money as I have on those stupid tickets, you kind of know a few of the songs. Big rally last week. Going to talk about some of that, what we saw. Going to talk about December, why we think this year-end rally still has some legs left to it. Fed talk. You've got some, what are we going to call it? Your conspiracy hat? You're going to put a conspiracy hat on? I don't know. And then I don't know, whatever else to talk about. A little Netscape versus ChatGPT. So last week, well, how about this? 2 weeks ago. By the way, the Uri and Timmer episode was 2 weeks ago. Had a lot of downloads. The YouTube channel did really well. So thanks everybody out there. We do have comments turned on YouTube. So feel free and give us any comments at all. We like comments. Everybody's all bared up. Everybody's all talking about the end of the world. And sure enough, Sonu, we had a huge rally. S&P up almost 5% in a 5-day rally. One of the best, I think it's the third best third best week of Thanksgiving ever. Best November week for stocks in 2012. Wow. Yada, yada, yada. You were on vacation. The first couple of days was just a bloodbath. And then all of a sudden we did
and there was a big reversal. I left, was it the 19th or something? There was a Thursday reversal. Yep. The market is up and then the market is down a lot.
It was down a lot. Thursdays have been by far the worst day of the year so far this year. So it's not a coincidence that last week we didn't have a Thursday. And, we did. We had Thanksgiving. And the market did really well.
I like that. We didn't have a Thursday.
So, you're getting caught up. It's kind of neat because you kind of come in on an 11-hour plane ride getting caught up on things. When you read about what all the wild stuff that happened on the way down and the way back up, what'd you find? What stood out about that? Again, coming in from 20,000 feet looking at it.
So much of it seems driven by the Fed, right? Okay. As Fed December rate cut expectations went down, all the way from 90% on October 28th, the day before the Fed meeting, down to less than 30%, on that Thursday, I should note, on that Thursday after I left.
Okay.
And then it just, markets are down, 4 or 5%. But markets being down 5%, come on, that's just par for the course, right? If you're invested in equities, a 5% pullback shouldn't worry you. But, we'll talk about sentiment and why, maybe people are, worried about even 3-5% pullbacks because everyone's so concentrated on the tech trade, right? Mm-hmm. But then when I was catching up, I was like, wait a minute. When I left, nobody was expecting a rate cut in December.
No, not at all.
Right. And I remember telling you that I think that's, I'm not saying there will be a rate cut, but I think we're closer to maybe at least 50-50. Mm-hmm. Right. I think it shouldn't be like, oh, we're definitely not getting a cut. And then I come back and catch up with like, wait a minute, odds of a rate cut are now back up to 80%. We'll talk about what happened and all of that. But coming back to markets, the S&P 500 had a massive week. Last week was up close to 4% and ended, close to flat, 0.1, 0.2% for November, 7th straight month of gains. I mean, this is pretty amazing.
Oh, it is. We've talked a lot with our Carson partners and their clients. After a 38% rally in 6.5 months on the S&P 500, it made sense we're going to have kind of a shake the tree moment. We had nearly a 6% peak to trough correction from the late October highs until right around November 20th, November 21st, and then we just had a ripper back higher. I don't think it's a coincidence though that markets needed that. We needed that, Sonu. I mean, everyone when the market was up 6 months in a row, the Fed was cutting, everybody was bullish. Yes, November is usually strong. Yes, at the last second, we just barely had a higher in November to be up 7 in a row. But I think it's legit that this rally continues. We needed, again, to refresh the fear. We saw some of that. You think about December. David, we can put this first one we can put up is December is rarely the worst month of the year. So only once in history has December been the worst month of the year. That was in 2018. Do you remember December of 2018, Sonu?
Yeah.
What happened?
I don't want to. It was again about the Fed.
Exactly, the Fed. Mm-hmm.
It was like Powell is probably a little too hawkish. And then December 24th, was it the 24th? It's only a half day of trading, right? And the market just crashed. And then we got this big rally. By the first week of January 2019, Powell sort of changed his tune, said, oh, maybe we will be cutting rates. And they didn't cut rates immediately. I think it was several months after that. But forward guidance, right? And this gets to, like, we'll talk about the Fed and, my little conspiracy theory and all of that. But forward guidance was basically, what pushed the market back up from that big bottom on December 24th, 2018.
Yeah, I've always said the market just threw a big fit. The Fed came off more hawkish at their December meeting in 2018 and just a massive near bear market sell-off. If you were there, you remember it wasn't very fun. But again, as we just showed, only once in history. You tend to have September 13 times in the worst month of the year, August 12 times, and October 10 times. Not too big of a coincidence. Then you've got May in there also. Sell May go way down 11 times the worst month of the year. So that's just kind of some things to think about. But so I was just crunching some numbers like I like to do. I'll go there in a second. December is the most likely month to be higher, 73% of the time. So no month is higher. It was down last year on the S&P 500. It's pretty darn rare to be down 2 years in a row in December. It happened in 2015, 2016, or maybe 2014, 2015. One or the other. Closed over government work, but right around there. Then 80 and 81 the time before that. So it's rare. But David, we can show this now. Another clue for a strong December. It turns out, going back 40 years, a first year of a presidential cycle. So where we are right now, the first year, December's been higher 9 of the last 10 times. So you tend to get strength for whatever reason. I'm not ignoring it. December of the first the first year of presidential cycle. But what we're sharing on the YouTube channel, when you're up 5% for the year, going into the last month of the year, so a decent year, up 5% last month of the year. Since World War II, December the first year of the presidential cycle, where we are now, when you're up 5% going into the last month, has been higher 12 of the last 12 times. Go back to World War II. So never lower. Every time December has been higher. So you have some strength going into that last month. You get a little more strength than normal. The average December is up 1.4%. So pretty solid. It's like the third best month on average. Now, just something for everybody, though, the last 10 years, December has actually been the second worst month. Only September has a worse return.
Interesting.
But, I mean, there's a lot of numbers, a lot of stats. We like to talk about these things.
Is that skewed by 2018, you think?
It is. It greatly is skewed by 2018. Well, like I said, last year, we were down pretty good last year. I kind of forgot that. We had a great rally. Market did well, but we did have a pretty big drop. And I think what some people noted was like NVIDIA, some of the high flyers came back. But you look at November, one last thing for me, I'll go to you. The S&P was up, we'll say 0.1, 0.2%, depending on total return or price return. So pretty much flat. S&P 500 in November, Sonu, equal weight. up
Okay.
1.7%. 8 out of 11 sectors outperformed the S&P 500 in the month of November. I mean, yes, it was technology. It was down like 5%. That skewed things. We talk a lot about how we look at this world from a macro view, but then managing real money in portfolios for our Carson partners and their clients. This, I think, last month or so really preaches home why we've said stay diversified. Don't go all in really any particular group, because then you see what happens. What do you want to add to that conversation?
I'll come to, because a big thing as we came into October and even November was that, we don't have breadth. Everyone was like, we don't have breadth, right? Tech has been stealing the show. And then in early October, we got a crash in crypto, right? And then, one proxy for crypto I like to look at is basically, non-profitable tech. Think of it as junk tech, right? So in the month of November, as you said, the S&P 500 went down 5% and gained back close to the same amount to finish the month of sort of flat. The NASDAQ was down negative 1.5%, was down 1.5%. David, we can put this chart up. This shows junk tech getting hard hit in November. Okay. And if you're looking at the YouTube channel, you'll see this as a purple line showing the Goldman Sachs non-profitable tech index. That was down 11.5%. In November, right? At one point in November, by the 20th of November, it was down almost 20%. And I wonder if that gets to why sentiment is sort of bearish. Because a lot of people are, more concentrated in that technology side of the market, both in quality technology, which is, think of that as a NASDAQ, and then in junk tech too, right? With all this other stuff. And then maybe crypto's in there too. Sure. Now, one thing that's interesting, and David, you could put this chart up too. This shows crypto getting rocked and getting decoupled from junk tech. Usually when I think about crypto, I'm like, I don't know how, I have a model for gold in my head, right? We can talk about gold. We probably should talk about gold because gold's been doing well again, right? But, crypto, I don't really have a model. So my proxy for crypto is small growth, junk tech, right? And usually they tend to be really tightly coupled. And they were really tightly coupled up until October. But now, since then, Bitcoin's gone down. Bitcoin's actually down, 2-3% year to date, maybe slightly more after what happened yesterday, the first day of December. Junk tech, Ryan, is up about 44%. Right? That's a huge difference. That's a massive difference, right? And I'm like, and part of me is like, I'm just saying this. I don't know how to explain it. I don't know what the deal is. I was going to ask you if you had any thoughts as to what's going on there, like why Bitcoin seems to have, and crypto in general is sort of decoupled from this junk tech.
Yeah, we've talked about this. Yeah, great question. Yeah, I was actually going to kind of ask you because I was watching CNBC this morning, and Carl Quintanilla looks at Jim Cramer. He's like, hey, over the past month, stocks are like flat. All right. So the S&P is like flat the last month, give or take. Bitcoin's down 30%. So like if you would have told me 4 weeks ago that Bitcoin's down 30%, I would have said, we're probably in trouble. Like we're going to have maybe a 10% correction in the market. I don't know. I mean, we'd probably be in some trouble. Yet we're flat. And you look at it, yes, a lot of it is tech, but I think markets really held up awfully well. I mean, maybe we're not quite as reliant as we were on cryptocurrencies before, using it as a potential proxy. And I still think it is a risk on, risk off. And we start to see more of a bottom and rally in crypto in December. That's probably going to be good for markets. But I think it just comes down to the thing we've been preaching. When in doubt, diversify it out. I look around the globe and I see new highs all over Europe, all over emerging markets, 52-week highs, different places. You've got these countries that have, metals and mining and financials and industrials, not a lick of technology in there. Those countries are doing just fine. Silver, I mean, who knows what people list as silver is just going absolutely crazy to the upside. Copper's near all-time highs. Gold did have a well-deserved break, starting to pull up a little bit, pull back, pull higher a little bit more. There's a lot of things going on here, and I think it just says, again, just don't go all in on technology. We have, maybe you could argue, the slightest of slight overweights in the money we run, but we're trying to keep our technology right about benchmark because we still think you need to have technology exposure. Look where all the growth just came from. Maybe they did get ahead of themselves. They probably did, some of those names. I mean, let's be real. But I love the fact that the markets kind of finding other leadership. So David, let's put this one up. It's literally the one without a title, but it is a chart that shows the S&P 500 and the S&P 500's advanced decline line. The advanced decline line is simply a cumulative basis. How many stocks go up versus down every single day. In the late 90s, what happened? That advanced decline line peaked in the late, I think middle or late-ish 98, went lower for years, but the market went up. Why was that? Because tech was just about the only thing going higher at the end of that bull market. And other major peaks outside of like a 100-year pandemic, we've seen advanced decline lines peak well ahead of price. Well, everybody, last week, the S&P 500's advanced decline line made another new all-time high, like we're showing on the chart on YouTube. And that, to me, the way I was brought up is breadth leads price. Sonu, this is a broad-based rally. This is not just 7 stocks anymore. The XMAG 7, there's an ETF, but I can't mention what it is because I'm not probably allowed to, but you can find it. There's a XMAG 7. So the 493 literally closed last month at its all-time high on a monthly basis. All right. Now that's only been out, I don't know, 2 or 3 years, something like that. But the other 493 are doing really well. You did a bunch of great work on earnings. Let's talk about earnings a little bit. You sent a daily note to our Carson partners every day, and it was awesome. You looked at earnings. That 493, they did pretty good too, right? I'm going to cough. So give me a second. I'm going to go on mute. I'm going to cough. You start talking. Yeah.
No, look, earnings are up, revenue's up, and even for especially compared, this earnings season to what happened in 2024, what happened in 2023, 2022, it was mostly about the U.S. economy doing well. And if the U.S. economy doing well is, why does that matter? Because that means revenue is strong for companies that have most of its revenues in the U.S. Yeah. Right? What was a drag was the rest of the world. Right? That's not the case anymore. This earnings season in Q3, we just finished that, revenue growth for companies with less than 50% of their revenues from the U.S. Right? So most of their, the majority of the revenues come from outside. Revenue growth was up like 10%, right? For everyone else, it was like 7-8% or something for the whole index.
And let's just hammer home 7, 8, 10. I mean, these numbers you're throwing around, that is
good numbers.
That is huge for revenue. I mean, that's like the best we've seen in 3 years. I mean, so
no, exactly. Yeah. And then it gets to the point of diversification. This came up in our conversation with Dorian Timmer as well last week. How do you want to ride that AI wave? You want to ride that technology wave, which, as you said, we are slightly overweight technology stocks. We like communication services. It's all in there. But at the same time, I think November was a case in point why you wanted to be diversified.
Can I jump in just for a second? Can I jump in just for a second? So again, on the morning call, you break all this stuff down, and I always get something out of it. We do with our partners every Monday morning. Communication services was up last week. All right. Tech was down like multiple percent. I forget the exact number, but usually those two kind of trade the same. Now, listen, but a lot of that was because of Alphabet. They came out with Gemini 3, which I'll admit, I don't think I can give a recommendation on a stock, but I will say Gemini 3 is pretty cool. I'll just leave it there. That's a big reason why. So that was a different part. But again, it was interesting that tech was weak, but communication services was strong. Maybe it's because of Google. But anyway, go ahead.
No, and then you had Meta in there too, going the other way and things like that. Again, none of this is a recommendation. But last month, technology, S&P 500 technology sector was down close to 5%.
Yep.
Right, 5%. And then you think, okay, it's very concentrated. Now, if that's all you own, you'd be in trouble. Maybe that's why sentiment is pretty bearish. But the S&P 500 is flat, which means everything else made up for that. Healthcare was up 9%. Staples are up 4%. And you think, oh, wait, maybe it's all defensive, risk off. No, materials was up 4.5%. Energy was up 2.5%. Financials was up just under 2%. So it wasn't just risk off and it's just staples and utilities and anything. No, you had very cyclical sectors, and especially materials. When materials do well, materials get a lot of their revenues from outside the U.S. too. Goes back to that international diversification thing. And then you look at just the MSCI EFA index, developed markets. That was up over 0.5% in November. And that's why, you want to be diversified. There are ways, like November was a case in point in how to diversify your portfolio.
Yeah.
Right. And EM was actually down. I think EM's part of that whole tech, EM is mostly China. It plays into that AI story, technology. So again, EM, it's not like we're slightly underweight EM, but look, I know people who are very positive on EM, but very positive on China. That's fine. But again, be careful of putting too much in that technology AI basket, right? You want to be diversified. There are ways to diversify right now.
Well, no, well said. Do you want to talk about gold? Want to go there? We kind of talked about a little bit, or do you want to?
Yeah,
what do you think?
Actually, let's talk about the Fed, and then we'll get into gold because I want to talk about Kevin Hassett too. And I think
so if we're going to go that route, anything else on equities? Then I'm trying to think of anything else. I don't think I want to talk about any equities before we totally shift gears. I think we covered it pretty well. Yeah,
I mean, maybe we'll tie it together because
one more for me. I think I've listed this before, but it is really, really rare for the S&P 500 to peak in October, right? We had the peak October 28th, October 29th, the Fed did a cut. It was like the smallest down day, one of the smallest down days ever on a Fed day. And then we had the sell-off. And when the market was down 5-6%, I mean, we were out there saying, we still think new highs are going to happen. I know I said that. People gave me some crazy looks 2 weeks ago. Now I was like, okay, now we're at chip shop all-time highs time we're doing this. But only 4 times the last 75 years has the S&P 500 peaked the month of October. Like one of the most recent was like 2008 or something like that. It's like, oh, you hear that? And no, 2007. Apologies, to be 2007. Sorry, wrong one. It's like, oh, you hear that? Oh my goodness, what happened next? But no, it's never that simple. We're still quite optimistic as we've laid out. But just know it's rare to peak in October. You have market breadth. You have a dovish Fed, like we're going to talk about. You have seasonality. You have everybody freaking out just 2 weeks ago about all the bad stuff they're telling you on TV. Again, that's the recipe for a year-end rally, and we're still pretty optimistic we're going to see it. So let's go to the Fed now. Kevin Hassett.
Actually, October 29th, when we recorded the episode, October 29th, the episode 159 came out to be titled that Here Comes a Year-End Rally. What happens after October 29th?
That was your idea. I didn't want to call it that. I said, buckle up. Here comes a mild sell-off. Sonu said, no, Ryan, you can't use that. Anyway.
So what happens October 29th? Powell comes out. That's the day of the Fed meeting, right? We recorded before the Fed meeting. We expected them to cut, but they came out pretty hawkish. And then throughout the first week of November, you had all these regional Fed presidents coming out of the woodwork. We talked about that, throwing cold water on December cut.
Honestly, the government shutdown too, even though that doesn't necessarily impact equities, it did impact consumer confidence. I mean, I think that's clear when you look at those numbers. We had no data too.
We had no data. We were flying blind. The Fed is flying blind. So, David, you can put this chart up showing December rate cut expectations. So the odds before the Fed meeting of a December cut was about 91%. That fell all the way below 30% through November 20th.
Okay.
Right. And the S&P 500 just followed that down. It was down about 5%. Then this is when I went on vacation. The next thing I know, wait a minute, rate cut odds for December are back up to like 85, 90%. And I was like, what happened? I think there were 3 catalysts. One is we got the September payroll data on November 20th. Right. That showed the unemployment rate going up to 4.44%.
Yeah.
Just a tad, 0.01 percentage points below being rounded up to 4.5%. Right. And of course, in September, we saw that there were 190,000 jobs. The employment population ratio was also steady. But the big number, headline number, is the unemployment rate has been going up. I think that was like, wait a minute, that should increase the odds for a cut. I think the market rallied a bit on that day. The next catalyst was on the 21st of November, New York Fed Governor John Williams comes out and says he sees room for further adjustment to rates. The labor market weakness, in his mind, poses a bigger economic threat than higher inflation, right? That took rate cut odds to above 60, 70%, something like that. And then finally, last week, the day before Thanksgiving, we got the Fed Beige Book. It's basically anecdotal evidence from all the different Fed offices basically across the country. They talk to businesses, they're pulling all this data saying, how do businesses feel? It's sort of like a sentiment thing. It's anecdotes, things like that. I think that sort of sealed the deal for the November cut. The most important message, this is from Bloomberg, in that Beige Book, it covers the period from early October through November 17th. Employment declined slightly, with nearly half of the Federal Reserve districts noting weaker demand for workers. That's a significant downgrade since the previous report, when unemployment levels were seen mostly as stable, right? So you had these 3 things, and I think that's basically what took rate cut odds, December rate cut odds back above like 80, 85%. I think Powell's probably in favor of another cut. I always thought he would probably, if he had to choose, like, do I not cut because I'm worried about inflation versus do I cut because I'm worried about the labor market? Given what he said over the last several years, I thought he's going to come on the side of protecting the labor market, which is why I think I was always like, I think we'll get a cut in December. I'm not so sure. I remember, we didn't have any payroll data, nothing like that. And now, I think Powell's in favor of another cut. We're in this quiet period, right? This is the period. Next week is a Fed meeting.
Right.
10, 12 days before the Fed meeting is the quote unquote quiet period where you don't get Fed governors coming and speaking, things like that. Maybe some of us could probably argue that the entire period between Fed meetings should be quiet periods and they shouldn't say anything. But look, we're going into the meeting with rate cut odds above 80%. So I think we are going to get a cut. The thing is, are we going to get now a hawkish cut or a dovish cut? Look, a cut's a cut. I think that's going to be positive.
Let me jump in there. One of the things we've talked about, usually the first Friday of the month, you get the monthly employment data. I believe we're still not going to get that this time, right, Sonu? Doesn't that come out until after the Fed meeting? So we're still getting we're getting some data, but it's all old.
It's all September data.
It's all September data, so I don't know if that's really going to change the Fed. We don't have employment data until after the Fed. Again, kudos to you because you said the whole time, listen, I don't think it's a 30% chance of a cut. I mean, you said it's probably always over 50-50 is what you were saying. And now there's more data and we know, and that's the way it looks like. So that's good. Just one more fun one. I think it's fun. So the Fed cut near all-time highs twice already this year, right back in September, and then literally cut at all-time highs based on the day before close. So the market closed all-time high October 28th. Next day, October 29th, they cut. 21 times, Sonu, back in history, they've cut within 2% of an all-time high. 1 year later, the S&P 500 is higher 21 times. I've mentioned this a lot. Who knows where we are next Wednesday, but we might be within 2% all-time high. We're there right now. We had the one in September, one in October. So there is the old saying, don't fight the Fed. As we head into 26, is the Fed still, dovish, you think, going into 26 then?
I think so, because Powell ends his term in May of next year. May, right? May, right? And President Trump is probably within the next week or two, I think, at least going by news reports, it looks like we'll get the nomination for the new Fed chair. It looks like Kevin Hassett is in the lead. He's the head of the National Economic Council. He's Trump's guy, basically. He's Trump's guy. Right. What does Trump want? Trump wants rate cuts. He's going to put somebody in there who will go for rate cuts, right? And the prediction markets, David, we can put this chart up showing Hassett as a front runner for Fed chair. Polymarket right now has odds of Kevin Hassett at 81%. Odds of Kevin Hassett being the Fed chair, right? Okay. And here's the thing, for all the noise, right? We went through so much noise in November. We're like, will they cut or will they not cut? And rate cut odds going down to 30%, going back up to 85%. If you look at 2026, what markets expect, markets still expected close to a 3% Fed funds rate. 2026.
So how many cuts is that? What would that
be?
That
was about 3 to 4 cuts.
So somewhere between 3 and 4. So it always stayed there.
It always stayed
all
there.
The short-term jockeying, whatever. But the market said, "Listen, you guys can argue about December. Yeah. We know we're still cutting next year." Is that kind of way to put it?
Exactly.
Okay.
Right. And I think that gets to our outlook too, without giving too much away. Right. I think there's a reflation story next year. The Fed is cutting. Don't fight the Fed. We're getting tax refunds. And we can talk about oil prices too. I think oil prices may be coming back a little bit into next year. Seems like that may be a contrarian call here. But I think we get reflationary growth a little bit. That's very good for stocks.
And let me jump in there for a second, because you and I were sharing a note with Barry and Grant on our team. I don't see, and again, the outlooks are all coming out, but I haven't heard too many people say reflationary growth. That's what we see in 2026. I mean, it doesn't feel like that. And that's one thing, I love where we're different than the crowd. I mean, listen, if everybody's modestly bullish, okay, well, whatever. But we've been different. Again, if you listen to this podcast, early in 26, we changed our tune. I mean, in December of 2005. So this year, this December. I'm going to get there, Sonu. This January. Apologies. I'm all mixed up, guys. I don't know. I'm hungry. It's almost lunchtime. Actually, you know why?
I'm the one with jet lag here.
I'm thinking of two different things at once. See, I'll just tell you. So I just got an email from CNBC. This is why I can't focus. I want to get on the show. So it's cool. So I'm going to be on CNBC today at 3:35 Eastern time, closing bell. By the time people listen to this podcast, hopefully it's already happened, and I didn't make a fool of myself. And I'm on with Mike Santoli, which is good. I'm a big fan of Mike. I thought it'd be Judge. I love Judge. Judge can be tough. So I'm on with Mike. So that'll be fun talking with Mike. Mike. Now, where was I? Oh, well, on this very podcast, literally the last week or so of January, early February, I'm out there saying maybe the dollar is going to peak. I know nobody was thinking about that. Very few people, my friend Chris Kimball, a couple other people were saying there's some reasons to think the dollar is going to go lower. Everybody said it had to go higher. And then Germany did its thing and all the fiscal stimulus. And then you and I were all kind of on the same wavelength, like, wow, maybe we should look around the globe more this year than we have the last 3 years or last 2 years before, while we like the U.S. And that's why, we make our decisions with the data. We let the data come to us. We're not always being right. We're not always being wrong. But it's cool because this podcast, we manage almost $7 billion on our team, right? When we talk, it hopefully matters. And I'm on CNBC, or Sonu is doing all his stuff, and our team manages real money. We're not just a podcast that just pontificates. We pontificate, and I know you got some theories coming up, but we actually bring it all back to managing real money to help our Carson partners, grow their businesses and help their clients sleep at night. All right, now I'll get off my totem pole there, or my
I think it gets back to that
about?
2026 bet. Like, our bet is reflationary growth.
There, right? that's where that's what I asked you about 17 minutes ago. Reflationary growth. Thank you for bringing me back.
That's a little contrary, because I feel like most people, like everyone else, is either in two other camps. One is, we're going to get stagflation. You have like the inflationistas. I'm not saying, I think the Fed has a little bit of an inflation problem. I do think it's not a huge problem because shelter inflation, disinflation will offset other things. But I still think inflation, if I had to pick, probably stays closer to 3% rather than getting back to 2%, which means they have a problem because inflation's now closer to 3% or above for about 5-6 years, right? So that's a long time. Right. So which means that's still a problem for them. But then they're still going to continue cutting. And like we said, don't fight the Fed. This gets back to if Hassett is in there. I think there's a good period for gold, too. Right. Yep. And there's a reason why gold is rallying, because the Fed is cutting in the face of elevated inflation. Right. We've talked about this. When did gold start its rally? After Powell's speech, its latest rally, I should say. Right. After Powell's speech at Jackson Hole. They said, you know what? We are more, forget the inflation stuff. We are more worried about protecting the labor market. We're going to continue cutting. And now, including the December cut, assuming they'll put a cut 75 basis points, 0.75 percentage points. That's a lot, right? Meanwhile, inflation's still close to 3%. I think that's why gold is rallying. But so anyway, we are on that reflationary growth, island, which is, I think, good for equities. It's good for gold. It's good for managed futures as well. Like all these commodities, especially with global growth going up, copper is up, right? Oil is aluminum's up, steel is up. Oil is the only thing that isn't.
I will say natural gas is one that's kind of near the top. I mean, I follow some smart people. They think natural gas could be one that, I don't know if we want to pay more, but from an investment's point of view, if you're thinking about these things, natural gas, maybe potentially oil, like in 2026, these could be playing catch up with some of these other commodities that have already soared. And it's just very hard for me, Sonu, to think there's some global recession coming when I see copper near all-time highs, when I see silver strong. I get it. Silver's got a little bit of both to it. It's got a little, precious metals to it, but also has some industrial stuff to it. So to see those things happening, it's hard to become majorly bearish in the global economy, which we're not. Exactly. But that's what the market's telling us.
And I think a lot of people, some people are like, oh, we're going to get inflation, but we're going to see slower growth.
Yeah.
Right? That's stagflation. Light.
That's a very popular call. I mean, that's a very popular call. Inflation could be trouble, but the economy doesn't grow more than 1% next year or something like that.
Right. That's stagflation light, right? And that's a scenario where you probably don't want to be overweight equities. I mean, if I was predicting that, right? That's a different, that's like, I'm not saying it's like the 70s, but some of these guys that's what they see. But, and then on the other side, you have the recession light, folks. Like, wait, the unemployment rate is going up, which is true. They're like, maybe the economy is in trouble. That's also a scenario where you probably don't want to be overweight equities. You want to be overweight duration. You want to be overweight long treasuries, because you think, oh, if we are getting close to recession, the Fed's going to cut a lot.
So in simple English, I mean, bonds, right? I mean, you want bonds. Just for listeners, we get a little geeky with our lingo sometimes. But you want to own bonds in that type of scenario, because bonds are a little safer, and they probably will give you some zig when stocks zag, and stocks zag would be down in that particular scenario, probably.
Now, where I think is, next year we could see some volatility is like, yes, Hassett could come in, or he probably will come in as a Fed chair. But there are 12 members who vote. There are 19 members total. The chair does not get to override, or doesn't get a tie-breaking vote or something like that, right? So the question is, can Hassett deliver the rest of the Fed to go along with rate cuts? I think they will cut, but it's not a certainty. And because of that, we could get a lot of volatility. Look, the administration's going to try and get their people on the FOMC by next year. The data going in that direction will help. Ideally, it'll be because inflation's moving lower instead of the unemployment rate going up. So it'll be like, it's good news. And that's why they're cutting, because of productivity growth, things like that. But yeah, we haven't had a divided Fed in a very long time. The last time we had a divided Fed, Ryan, was 1994. A lot of Fed officials wanted to raise rates in 1994 faster than Greenspan did. It actually caught Greenspan by surprise. Since 1993, I looked at the data, only 5 meetings since 1993 have had 3 dissents. The most recent one was 2019, right? The last time you had 4 dissents was 1992. Now, in this December meeting, we may get 4 or 5 dissents. The vote may be 7-5 in favor of a cut. But what does that mean? Meeting by meeting, we're going to be like, is it going to be 7-5 in favor of a cut? Or if 2 people change their views, it's going to be 7-5, in favor of no cut, right? So we're going to be flipping back and forth. We're going to have a lot more volatility when you have more dissents. I mean, in fact, there's some academic research showing that, markets are more volatile when there are more dissents. And I think that actually may be Powell's legacy here. It's not going to conspiracy theory. Well, here's one way to look at it. You had all this hawks versus doves commentary, right, over the last month. You had the regional governors who were like hawkish. Then John Williams, the New York Fed governor, comes out and says, I think, we can cut more. One way to look at this is Powell's lost complete control of the Fed. It's a free-for-all, right?
Yeah.
I don't think so. I think he's like, you know what? You guys go out there, push your views. That's okay, right? He's promoting dissent. That's a way of keeping the Fed independent.
Is this when you should put your conspiracy hat on? Is it we're going with
and
this?
I think what he's saying, his final legacy when leaving the Fed is, all this time he's been the one, we've talked, I forget who we talked to, is that before the meeting, Powell calls everyone, tries to get a consensus view. That's why most votes are unanimous. Now it's like, you know what? You guys dissent. That's okay. He's sort of minimizing the role of the Fed chair just before he leaves. Just before Kevin Hassett comes in, and it's a complete free-for-all.
Get that seat nice and warm. There you go.
And make it a little hot seat, right?
Yes.
Because, if like Hassett's got to have to wrangle all these guys, Powell set the tone for, you guys go out there and dissent. Have your own views. It's okay. And meanwhile, the president's screaming at Kevin Hassett saying, I appointed you for rate cuts, but you're not giving me my rate cuts. Right. I'm going to fire you. So I think next year we'll see some volatility associated with this. I still think they'll cut, but, brace for, a lot of dissents, some market volatility around Fed meetings. If you thought what happened over the last month was volatile because of, Fed rate cut expectations, get into March, May, and June of next year, I think we see more of this.
Yeah, that's good for having a podcast because our views and downloads do go up when the market goes down. Now, we don't really want the market to go down. We want it to go down and then come right back up. Is what we do manage money, right?
Yep.
So there's a lot there.
I know that was a lot. Sorry,
no, it's great. No, it's awesome. Great discussion.
Yeah.
As we head into 2026, we'll talk a lot more. Speaking of 2026, so I did see we just got an email from Barry Gilbert on our team. He shared the Outlook 2026 draft with us. So we are working furiously on our outlook for 2026 from the Carson Investor Research Team. We know a lot of people who listen to this podcast are excited about that. We're excited about it. Hopefully it comes out around the 1st or 2nd week of January. Can't give an official time because we're not even sure, but that's when we're shooting for. Why do we do that? A lot of places, I literally saw some outlooks are already out. Literally out already. I personally love the idea of not doing it that early, letting the year settle, and then releasing it. And I guess it's because people want to get out there first, but we don't play that game. We manage real money. What we care about is helping our partners grow and making sure the money we manage is doing what it's supposed to be doing. We love content stuff. We love creating. We love writing. I guess maybe that's the answer is we're not trying to be first. We're trying to be right when it comes to our outlook. So our outlook will come out in early 26, but it's there. Anything to add to that, Sonu?
Yeah, and a lot of times the people writing the outlooks are not the ones managing money.
Exactly. That's why they want to have. That's what it'll be first because you can get ours out there first.
Yeah.
PR loves it.
But I think this time it matters even more that you come later because we haven't got any data. All these outlooks that are coming out are based on data we got through September. right?
Yeah.
The next payroll report we're going to get, I think it's December 17th or something like that is when we're going to get it. 16th or 17th is when we're going to get the November payroll report. By the way, we still haven't gotten Q3 GDP data. So all these outlooks that are coming out is based on Q1 and Q2.
Yeah.
Right? We haven't gotten Q3 GDP data. We're going to get that, I think, on December 23rd. Right? They're not going to give us the initial estimate. It's going to be the second estimate, but that's fine. It's still what it is. But yeah, that's why I'm even more comfortable about the fact that our outlook is coming out only in January, because by then we have a better picture of, where the economy was in Q3. Right now, everyone's going by where the economy was in Q2.
Well, very, very good stuff. We've gone long. We didn't have much of a script, and as usual, we just go. I mean, I do want to touch on one thing, David. The last chart I sent that overlays ChatGPT with the IPO from Netscape. The Netscape IPO came out, Sonu, August of 1995. The S&P 500, the first 3 years after that, doubled. Why does that matter? Because we just hit the first 3 years when ChatGPT, did I say it right? ChatGPT came out just 3 years ago on November 30th. NASDAQ's up about 100%. Now, as we're sharing the YouTube channel right now with this chart, and a lot of people share this chart. I made my own version of it because it was the 3-year anniversary of ChatGPT coming out. The NASDAQ back in the late 90s, 3 years after it gained 100%, after the Netscape IPO, doubled once and then doubled again the next 19 months. Now, we're not calling for that. In fact, I don't want to see that. But what we are saying is, if you kind of, and I get it, there's a lot of different factors here. But just because this wave has gone for a while doesn't mean it's over. Right. And I think it's just really important to note those things while we still think there's reasons to be quite optimistic as we head into next year. And maybe technology still does well. Yeah, it had a strong way to put it. A rough November, got ahead of itself, but there's still some reasons to like it. Sonu, we probably need to wrap it up because I have to do another podcast in like 4 or 5 minutes because we started late. What do you want to end this Taylor Swift themed back to December podcast? What do you want to finish with here?
I think the wave continues for a while. I mean, I'm just looking at a headline on Yahoo Finance saying OpenAI's Altman declares code red. Code red.
Code red's all over the place.
As rivals gain. And you just mentioned Gemini, right? But what does that mean practically? That means they're going to need to spend more money. Right. Yeah. They have, and then, their rivals will have to spend even more money. And when these companies spend money, that's profits for other companies, NVIDIA's of the world, etc., because they have to buy chips, they have to buy power, they have to buy all sorts of things to set up data centers. So I think this continues, right? For now.
Well said. NVIDIA peaked on October 29th, and over the next 20 to 25 days, approximately lost almost like $850 billion. I remember it peaked at 5 trillion. So it's going to give some back. It's volatile. But if you look at what Alphabet did, so Google, Alphabet, from October 29th until the same period, it gained like 650 to 700 billion market cap. So no, it wasn't a pure one-to-one, but I think it's a real good way of showing there's a lot of things sloshing around in there. A lot of people are overweight these high-flying tech names, and hey, they've done great. But when you have these big pullbacks like we've seen in those names, that's why everybody feels like they're freaking out when you look at magazine covers and sentiment polls and put-to-call ratios and all that stuff. Again, keep a diversified portfolio, own some gold, own some yen futures, own some cash, own some bonds, own some Europe, own some EM, own a good chunk of US with a little bit of a large cap tilt, maybe split value growth kind of makes sense, maybe own some momentum, maybe own some low vol. What I just said is how we manage our portfolios. We sleep well at night knowing we're still overweight equities with a lot around the globe, but we've still got those diversifiers to help diversify that other 40% bucket, which in our case is not quite a 40% bucket. But nonetheless, that helps you sleep at night. All right. I don't know. I think we're done. We done, Sonu? Anything else? What do you want to say?
I need to get a nap and get over jet lag.
I'm traveling out to Arizona tomorrow. Nice. My wife is turning 50 years old.
Are you supposed to tell everyone that?
Yeah, I don't know. She's 29. My wife is turning. My second wife is turning 29. I don't know.
Did you buy her a nice gift? Did you do a Cyber Monday shopping? Or
I haven't. I've got some ideas. I haven't done anything yet. We'll see. I'm thinking maybe just get something out in Arizona. Let her just pick it out. I don't know. Make it easier.
I still don't know what to get my wife for like a birthday present or anniversary present. I mean, she's just so. I think I'm hard to shop for, but I don't know.
I'm terrible at it. I mean, I try. So I just always take it on a nice trip. I don't know. That's kind of
that works. That works.
Yeah. So anyways, everybody have a good week. Hopefully you're not in the snow, but where I'll be, there's no snow, so that'll be nice. Thanks all the listeners out there. You give us a like, give us a follow, give us a review. Not positive, not negative. I can't lead the witness. I got in trouble for that before. Give any types of comments. We do like that. The algorithms love those things, and we're just excited to keep doing this podcast. Hopefully everybody's enjoying the holiday season, which is coming up. And hopefully the potential. What's that beeping? What is that? What is that beeping?
I don't hear anything.
I don't know what that is. Whatever. Maybe it's time to stop talking is what that is. Hopefully you enjoy the potential end of year rally, which we're still pretty optimistic is going to happen. We'll see you by next week. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.